you so much for joining us today. I'm going to steal something from Mike Chen's presentation, his Rubico presentation yesterday, when he spoke about innovation. And he said it's not just a nice to have, it is an imperative. So I'm going to copy that and paste it on this, which is redrawing the political lines of global influence. So I think in a world where we have ushered in a higher level of geopolitical risks and uncertainty, it's not just nice to talk about what's happening in the geopolitical sphere, which we did last night at the dinner table written, but it is also an imperative to know what is happening with the geopolitical risk and how that affects the economy and whether there's going to be a market implication arising from that or not. So in order to start this talk, I'm going to take you firstly back 2,000 years, because I think it bears noting that in the world economy today, we got quite used to the US hegemony that prevails. And we almost forget that emerging markets at some point in history did in fact play a much larger role. And so if we go back 2,000 years, and I've got some data here from Merrill Lynch, you can see that the purple and the orange portions of the chart, which represent China and India, were in some cases quite significant. So we had the rise and fall of empires at the beginning. And when we got to about 1500, we saw that the Chinese economy accounted for a quarter of global GDP, with India a second contestant at 24% of global GDP. Then we hit the 1800s, 1800 to 1900, where we had the Industrial Revolution, and we had economies like the UK increasing in prominence and Europe becoming a larger portion of world GDP. Then going into the 1900s, we had the First and the Second World War, and on the back of the success of the US economy, we then saw the US economy becoming a much larger component of global GDP, close on to 35% of global GDP. Now, yesterday, you would have seen in Ravi's JP Morgan presentation, there was a period in which Deng Xiaoping managed to actually double growth in China on the back of significant economic reforms that were implemented. And that's where we saw the Chinese economy once again becoming a much larger player in global GDP. Following the rate of globalization that then increased, we saw that emerging markets over that period of time has become a far more dominant factor in the world economy. So I think this bears noting that we've almost kind of, closed the circle on this. And going into 2050, Merrill suggests that based on current trends, we should see the Chinese economy once again making up 25% of global GDP. And with the trend rate that we're seeing in Indian growth, we should see the India economy also contributing close to 15% of global GDP. And over that time frame, we should see that the US economy is likely to drop from that 35% peak of global GDP to almost half of that level when we get to 2050. Now, one of the big key drivers of the contribution to global growth and growth in an economy arises from the population growth, in particular the working age population. And so this is a list of all the countries that we're looking at in terms of developed markets and emerging markets. And it looks at the working age population between 2013 and 2038. Now, quite interesting, generally speaking, your developed market economies with lower rates of fertility suggest that those economies would have negative growth in working age population. And the US stands out as a bit of a contrary indicator on that, given that we are likely to see growth in the working age population for the US, which bodes well for trend growth in that area. So we're expecting trend growth in the US over the next couple of decades to look a little bit better than what we're expecting in Europe, where working age population growth rates are likely to be negative. Similarly, China stands out as a bit of an outlier on the emerging market side because they have the one-child policy. And so this is going to act against that demographic dividend for China. Now, this is not the only contributing factor to the success of growth rates going forward. And South Africa is a key example here. So we've got quite a low median age in South Africa, but it does depend on the economic conditions of the country. It depends on whether the labor market policies encourage female labor force participation, getting older workers back into the labor force. And it depends a lot on those conditions of educational attainment. So as a result of that, even though Africa has quite a young population, we are anticipating that India will make better use of that demographic dividend because of those three conditionalities. Quite interesting to see how the global economy has become quite split on a regional trading bloc basis. And a very nice article by Jeffrey Sachs on Project Syndicate states that when a state feels destined to rule, this leads to the state bankrupting itself through imperial overreach. So this is how we've seen global powers ebbing and flowing over time. And given that debt in the US economy has reached quite a significant level in post-war history, it does suggest that the US's dominance is coming to an end in a world where we shifted from unipolar to bipolar to multipolar forces in the global economy. This also implies that it's ever more important for economies to have open trade dynamics with various economies in order to boost economic prosperity. But what we've seen with the likes of the US economy is that they've pulled out of a number of trade agreements, almost locking themselves out of that potential economic prosperity in a world where we have these regional trading blocs. This is yet another factor that suggests that the US's contribution to global GDP over the next couple of decades will in fact decline. So in a world where we have this economic fragmentation and where we have the US economy contributing far less to global GDP than what they have in the past, the natural question arises around the dominance of the US dollar and will this continue to prevail? Now, in our opinion, given where the data lies today, it does suggest it's going to take some time for the dollar to be replaced. There is no, quick second competitor waiting on the sidelines to overtake the dollar right now. And for us, the US dollar remains the preeminent reserve currency now. So it's very clear that the dollar is overvalued, and that means that over the course of the next couple of years, we would expect a gradual unwinding of that overvaluation. But I say gradual, so we're not expecting the dollar to fall in a heap because of the dollar dominance story coming to an end. So on the left and right hand side here, you can just see the valuation of the dollar relative to the developed market currency basket on the left and the emerging market currency basket on the right. And you can see that the dollar is quite overvalued. So again, over the next couple of years, we would expect to see that unwinding. However, we don't see the dollar crashing, given that it is still playing a very fundamental role in the global economy. So on the left-hand side here, you can see that the dollar still plays a big role in global FX reserves. So yes, it has declined. It's come down from 70% back in 2000 to about 60% today. But you can see that the next closest contenders are quite low on that list. Now, we often hear the case for, what about the renminbi? They're doing a lot of trade in Asia with the renminbi. The renminbi is stuck in that little blue line, which you can see has been ticking up. So if we blow that up, you can see that it's still, cumulatively, still only about 10% of the total. And yes, there has been this push for more reliance on the Aussie dollar, Canadian dollar, and the renminbi. But in comparison, it is still quite small to the dollar's prevalence in the market. Similarly, there is quite a big demand for US dollar-denominated assets. So in an environment where geopolitical risks are high, investors are still seeking out a safe haven in the form of US dollar-denominated assets. On the left-hand side, you can see there has been a structural upward trend in the foreign holdings of US treasuries by the likes of China, Japan, the UK. And on the right-hand side, even taking account of assets outside of treasuries, there is still quite a big demand for those dollar assets. So with all of the talk around dollar de-dollarization and having a BRICS competitive currency, there is still this push for the dollar as the safe haven asset in the world. Similarly, you can see that the demand for US dollars on a transactional basis remains very high. So yes, in certain segments of the market in the world, they are using more renminbi for trade, but by and large, the dollar still makes up 50% of international loans, and about 60% of international payments are still done in US dollars. Where we have seen a bit of a shift in the foreign exchange reserves is a move to gold, which also acts as a safe haven in times of geopolitical strife. And I think this really gained quite a bit of momentum after Russia invaded Ukraine. We saw that the US economy imposed a number of sanctions on the Russian economy. They also clamped down on the FX reserves. And we found that a lot of emerging markets became quite nervous on the back of that, particularly with regards to where these geopolitical lines of influence are being drawn. And on the back of that, we've seen that many governments across the world, through their central banks, have now started to mop up more and more gold. And we've seen that central bank purchases of gold have been the highest that they've been in decades in the last couple of months. That said, if you look at gold as a share of total foreign exchange reserves, it actually remains quite low. So admittedly, yes, we did have the gold standard at the beginning portion of this chart. Notwithstanding, if you look at the gold share of total foreign exchange reserves, it is still quite low. And in a world where we expect geopolitical risk to remain quite high, this does provide a bit of an underpin for gold going forward. COVID-19 brought a couple of things to society across the globe. One was this move away from the over-reliance of global supply chains. And so we saw more regionalization taking place. We also saw that people had a cost of living crisis to live with, and that on the back of that, they became very disgruntled with the current incumbent governments. They were looking for alternative parties to take economic prosperity forward. And on the back of that, we've seen this rise in populist support as electorates now start to give their support to fringe parties looking for some kind of change in order to get income per head up again. Now, if we take data from 1870, and here I'm citing Martin Wolf, who wrote an article in the FT in 2017, he drew a comparison between the rate of globalization and the rate of democratization. And so prior to the world wars, you can see there was a general upswing in globalization, and that was accompanied by a period of democratization. In the period where we had the two wars, we had global income per head on a decline. That meant that educational attainment was lower. The need to feel politically included by the electorate fell, and as a result, your democratization rates fell. Then we had a period where they recovered again, but more so after the Cold War, where there was this push for political inclusion by the electorate. And as a result of that, we saw a very big drive for globalization and a very big drive for democratization. Now, this article was authored just before the COVID-19 pandemic. And of course, post the COVID-19 pandemic and the two wars that then prevailed thereafter, we saw a massive cost of living crisis. We saw income per head stagnating and in some economies actually declining. We saw educational attainment dropping. This need for political inclusion also waned. And as a result of that, we actually saw that globalization was now kind of stagnating, what they refer to as slowbalization. And on the back of that, we've actually seen that this push for democracy has gone backwards and what they refer to as democratic backsliding. Now, if we look across the globe, yes, there are some countries that have seen an improvement in their democratic scores, and this is captured by the Freedom in the World Index. But overwhelmingly, there have been more countries that have actually seen a backsliding in their democratic value system. And so if you take this on a net basis and you look at that turquoise line, we've had 17 years in which democracy has effectively been on the back foot in the global economy. There's also some good data from Ipsos, which conducted a poll in December last year. And what they were really trying to ascertain with this poll is there more of a push for populism in certain economies that feel that there is an us, an elite and the rest of us? And then they call that the broken system index. So the higher the score, there's more propensity for populist pressures to arise. And so they ask a couple of questions in this survey, such as, is the country rigged to advantage the elite? Do you agree with the sentiments around traditional parties and politicians don't care about people like me or don't understand the lives of people like me? We need a strong leader to take the country back. We need a strong leader that is willing to break the rules. So these are all angles of populism and populist rhetoric. And if you look at the light bars there, these are the countries where we have high levels of potential populism erupting. But these are also the countries that have experienced elections this year. So if you roll that back a year, we've also seen, the likes of Brazil, which is over here on the chart, and the likes of Argentina, which is here, also having this increased push for populism, and this has clearly been in line with the cost of living crisis. However, we've seen that populism doesn't always benefit the economy when it takes on a more nationalistic approach. And this is exactly what we've seen playing out in Brexit. And so on the left-hand side, we've got the Office for Budget Responsibility that is looking at the trade account for goods and comparing what has happened in the UK since Brexit to the rest of the G7 counterparts. And you can see on the goods side, there's been an underperformance. So I might get a bit excited because on the services side, it looks like Brexit actually helped on the services trade dynamic, but this line masks a lot. So yes, pensions and insurance businesses did a lot better, up 40% relative to G7, but transport down 20% relative to G7, financial services down 25% relative to G7. So when you take these two together and you look at the trade account and how that has contributed to GDP, the Office for Budget Responsibility says that if it hadn't been for Brexit and Britain had actually remained, GDP would have been between 4 and 5 percentage points higher. So the data shows us that this nationalistic approach is a bit harmful to economic growth. Nevertheless, we continue to see populist support emerging in other areas in Europe. And more recently, we saw in Germany, and they had state elections in Saxony and Thuringia, and we saw that the far right-wing party, the AfD, and BSW, which is a far left-wing party, again, support for the fringe parties, actually gained in prominence in this last election. Why? Because of immigration issues, and they believe that the government is not doing enough to integrate immigrants into the everyday life of the German citizens. And as a result of that, not being fully integrated culturally, not being fully integrated into the labor market, this is becoming a big drag on the fiscal dynamics for Germany. And as a result of that, we're finding that the populist support measures are actually picking up in areas like Germany. We're also seeing this playing out in terms of the trade interventions that are coming through on a global basis. So yes, there have been an increase in the number of trade interventions that are liberalizing for trade. But if we look at the ones that are harmful for trade, these have far exceeded those that are liberalizing, particularly post the COVID-19 dynamic that's played out and shifted global supply chains. A lot of that has been because of the trade wars between the US and China. And so this long-standing trend of the US importing and exporting more from China have now actually come to an end, and we're seeing a bit of stabilization here. And what we saw from Colchester Global Investors is that there's a very high probability of tit-for-tat retaliatory policies. So if there's a subsidy that comes through, there's a 75% chance that there's going to be some form of retaliation on the other side of the trade dynamic. As a result of that, we've seen that trade with China has actually fallen quite significantly post-Trump coming in 2016. And what has replaced that is this idea or notion of onshoring or nearshoring, bringing those production lines closer to home. So people no longer think about just in time. They're thinking about trying to get their goods and services on a much closer basis to not be totally reliant on certain global supply chains. And we're seeing the likes of Mexico now actually taking some of that benefit away. So we're at a situation now where they trade more with Mexico than what they do with the Chinese economy. In a world where we move from this unipolar power of the US to a bipolar system with the US and China, now to a multipolar system that represents the poorer nations in the global economy, there is a push against the multilateral institutions. Places like the WTO, the World Trade Organization, the United Nations, the World Bank. The poorer nations do not believe that they are effectively doing multilateralism to benefit the poorer nations in the global economy, and this is going to have severe repercussions for global cooperation. In a Brookings survey, they basically asked the global north and global south, do you need effective multilateralism? In the last 2 decades, was it an important thing to have in society? And 80% basically agreed. Didn't matter if they were representatives of global north or global south. However, 70% of both the global north and global south agreed that multilateralism hasn't in fact been effective and something needs to change. Now, when they did a little bit of digging and they asked the survey participants, why is multilateralism not working? Why are these institutions not effective? It's because they're not doing the right things to address climate and the environment, poverty and inequality, human rights and democracy, peace and security. And so these scores were actually quite high in terms of it being ineffective. Now, in the global economy, and I showed you those trading blocks that have started to emerge, it's ever more important for us to have global cooperation to try and resolve for things like fiscal prudence, to try and resolve for things like poverty and inequality and combating climate change. But in a world where we have competition against the WTO and the UN from the likes of the BRICS and other institutions in the global south, there is almost a push away from the multilateral institutions that used to be governing on global governance, and now there's a shift away from this. This is quite an important picture for trying to get global cooperation back on board, and I think this is something that the world economy is going to struggle with going forward, given the separation of the trading blocks and us moving into a multipolar world. Geopolitical flashpoints continue to underlie these geopolitical lines that are continuously being redrawn in the global economy. Interestingly, the World Economic Forum, when they survey the sovereign wealth funds and central banks, they say that the number one risk in the next year is geopolitical risks. Even if you change that time horizon to 10 years on the right-hand side, and you can see what they're worried about is a little bit different, the number one risk is still geopolitical risk factors. And I think one of the reasons is because we've come out of this peace dividend post the Cold War, but now we're starting to see political tensions picking up again. And on the back of that, there's more of an emphasis on defense and military spending across the globe. And we're starting to see these lines now ticking higher. There's a big sort of increase that we've seen on NATO spending on defense. In the last while, this is on a 2024 year-to-date figure. And if we look at all the various economies that belong to NATO, most of them are going to achieve that 2% of GDP target on defense spending. Why is this problematic? Because it's coming at a time when governments have spent an inordinate amount of money to save the economy post-COVID. So debt levels are high, and this could lead to a misallocation of fiscal resources at a time when we really need to boost economic prospects across the globe. We had a very interesting discussion on what is happening in the Middle East more recently. I think from the three scenarios that we thought could play out, the highest probability was for this continuation of low-level fighting in the Gaza Strip with an eventual annexation of Gaza. But I think we have to admit that over the last 2 nights or so, where we've seen, quite a ramping up in conflict in that area, that scenario 2, the all hell breaks loose scenario, is gaining in prominence. And this is a scenario where the world economy becomes involved. Players like the US and China potentially become involved. Global market volatility could be at risk. Oil prices could spike. Why I say that, maybe the probability for that red block has potentially increased is that one of the flags I highlight here has actually been ticked. The fact that there is more intensified conflict between Israel and Hezbollah. A lot will also depend on the outcome of the US election and support for that region, as well as the outcome of a potential Israeli election. It's a small economy and the war is draining their resources, and people that live there, do not want this to continue for much longer. GDP is falling, inflation is increasing, and workers are leaving Israel. A lot will also depend on Iran's response and the response of Iran's allies in this kind of environment. So again, as I say, I think the base case probability is for this scenario 1 to take place where the conflict is reasonably contained and doesn't spill over into a more worldwide conflict with global implications. But we can't turn a blind eye to what's happened over the last week, where I think some of these tripwires have been triggered. With regards to the Russia-Ukraine war, almost a similar scenario where I think there's going to be this long-standing conflict between the two economies. And so if Russia by now hasn't managed to take more land, they've taken about 17 to 18% of Ukraine, and that's been over, the 2 and a bit year period, and they haven't managed to do much more. It does suggest a much lower probability of NATO becoming involved in the conflict. And so we see that a long-standing war between the two is likely to prevail. And it will ebb and flow in markets. So you will get, a drone or missile attack, and then we get volatility picking up, and then it'll go quiet again. And this is our base case scenario for that area. I think the big sort of questions is, can Ukraine remain in the fight? They are very dependent on getting military capabilities from the likes of the UK, Germany, and the United States. And again, a lot will depend on the outcome of the election. And on the right-hand side, the second question is, can Russia actually keep up the tempo of their current operations? So the Economist publication says that they can send about 200,000 new men to the front line every month. So it's not manpower that's the problem, but their capabilities in terms of military equipment, which is aging quite significantly, means that they're quite reliant on imports to come through from China, and quite a big portion of the other components here, the yellow, is actually North Korea's and the Iran's. So I think, from here, we are assuming in the base case scenario a long-standing conflict within those regional lines, not really spilling over in any massive fashion to the global economy. We have to also consider what's happening this year, given that it's a high election year, and the one that we're all watching for purposes of national security and economic stability is what's happening in the US economy. And here I've got the polymarket betting odds that were done on the 13th of September. But it looks as though we're going to have a split Congress according to where the betting votes are lying right now, and almost a coin toss for the role of president. Very quickly, I just want to kind of give you an overview, and I know we did get a bit of this from the JP Morgan presentation yesterday, but I think, we've got a spectrum of political outcomes that could arise from the US election. On the one side of that spectrum is a red sweep where we get a Republican Senate and a Republican House. And in that kind of environment, we would probably see an initial boost to growth because of lower taxes. We also have the likes of the blue sweep, which is a Democratic Senate and a Democratic House. And in that kind of environment where they actually want to raise taxes, it could initially actually be growth negative. But further down the line, it would actually be a better outcome for fiscal responsibility and debt. We've got the two outlying scenarios here, which lie somewhere in between because it's a split Congress. So, it's less easy to push through legislation when you've got a split Congress. We also believe that in the red sweep, initially markets will like it because it means a rollback in regulation. It means lower taxes. But then the market cottons on to the potential for higher tariffs to come through, higher inflation to come through. And that ultimately, on the back of weaker potential government deficits, that's going to worry the market. So further down the line, we see some growth in market concerns. With the blue sweep, again, initially, it's not going to look that great for markets because regulation will intensify. We'll probably see higher taxes coming through. That's not going to be good for corporate profitability. But the longer-term picture is that there will be fiscal prudence exercise, and that will be good for growth. So ultimately, we're also quite concerned about what happens on the foreign affairs side. I think the best outcome for the global economy is essentially a blue sweep or a Harris with a split Congress. What would be very negative for emerging markets is a Trump 2.0. I wanted to end the presentation just talking a little bit about South Africa and my own local market. I mean, we've also had elections late in May, and for the first time in a long time, there's actually a positive political surprise that emerged. And I think there are a lot of hopes hinging on a full economic recovery on the back of the government of national unity. A lot of, I think, political optimism has been priced into markets in South Africa. We saw bond yields reacting, initially equity markets as well. But we also saw it play out in the currency. And so the SA Rand actually outperformed what happened for the typical emerging market currency and what happened for the typical commodity-related currencies. So it wasn't just the fact that commodity prices did X or the fact that it was a general risk on. What actually happened was there was some political optimism driving further strength in the Rand. And that was also borne out in terms of the credit default swap spreads, which basically tells you about the ability of government to repay. And in this slide, you can see that our risk since the election actually came off. We bucked the trend of the emerging markets where risk actually picked up. On the ground, however, businesses are still hesitant. And so you can see that, yes, business confidence ticked up, but it's still below neutral territory, still in negative territory. Anything below 50 means that businesses are feeling pessimistic. Why are they feeling pessimistic? They're worried about the political climate. And so the political climate concerns are still very elevated, around 84-85%. How do we fix that? We fix that through generating more structural reform efforts. Now, we've got a fantastic project office that sits within the presidency, and they've been looking at things like energy security, water supply, logistics. Going forward, they're going to be given another 5-year term to be looking at local government failures and how to fix governance at that level. Doing what they've done in the past 5 years, they've said that they've basically unlocked 500 billion rand worth of investment prospects for South Africa, and that could lead to SA getting to that 3.5% handle by the end of this decade. And I think that's the type of growth rate that can emerge from continued structural reform under the government of national unity. Are we ready for an upgrade in South Africa? Here we're just looking at the notches away from investment grade, back all the way to 1994 when South Africa became a democracy. And I think, again, just like in 1994 and 1995, there will be a wait-and-see approach. The proof will be in the pudding. So initially, even though we went into a democratic environment, the rating agencies didn't yet trigger upgrades. But in the period where we saw growth getting to 4 or 5%, and yes, that did happen in South Africa in that part of history, we actually got quite a big sort of increase coming through on the ratings. At some point, Moody's actually had us at an A-. But thereafter, we had the global financial crisis, so less economic growth, less fiscal prudence, and we saw our ratings actually declining. And then we got hit by COVID, so the ratings stayed as low as they are. So we're about 3 notches away from investment grade. We're not going to get into investment grade tomorrow. We will have, quite a bit of time to actually get there with the structural reform efforts that have come about. But over the next year or two, we're quite confident that what we've seen coming out of the government of national unity and the structural reform efforts thus far, that we could potentially see our outlook getting to positive, and over the course of the next 2 years, starting to chip away at these ratings and starting to move closer to the investment grade rating for SA. The final part of the presentation is just basically looking at navigating this new world order. So what? With all of these geopolitical risks, does it actually have an impact on the economy? Did it actually affect financial markets? So you can see that over the long term, the geopolitical risk that we're currently dealing with today is nowhere near as high as what we saw in World War I or World War II, but it is definitely increasing above that long-term average. A great paper from the Bank of England looks at the level of geopolitical risk and how it actually affects growth in the next year for developed markets and emerging markets. And you can see that when there's a spike in geopolitical risk, it tends to draw away from emerging markets more disproportionately than the hit to developed economies. And so what this says is that if you have a certain amount of geopolitical risk that comes through, you would probably end up with emerging market growth being about 0.5% weaker on a year basis. The 5th percentile looks at if you have, a massive hit on your geopolitical risk, and it looks at that outlying factor. And that basically says that you have an even bigger disproportional hit to growth in that kind of environment, almost shaving off 1%. Similarly, if you look at inflation, geopolitical risk lends itself to a higher volatility environment, a lower growth environment, and a higher inflation environment. And so again, you can see that emerging market economies bear the brunt of geopolitical risk, particularly when you get a hit that involves the oil price market, and then you see that inflation can actually be significantly higher in that kind of example. So that's all involved. That's what happens in the economy, but what happens in financial markets? So Deutsche Bank did a study where they looked at 28 major geopolitical events in history, in the post-war history, and they looked at how long it took the market, the S&P 500 in particular, to recover, and it took about 17 days. So yes, there was a short-term impact, and it was very harsh, but it came out of the wash very quickly. However, there was an impact further down the line, and that impact wasn't really on the initial effect of geopolitical risk. It was borne out through the indirect effects of what happened to inflation and what happened to growth, and that then starts to affect the market. Similarly, if you looked at the bond market, the US 10-year Treasury yield, 14 days to recover prior to that geopolitical risk factor. So again, it comes into the system, there is this knee-jerk market reaction, but then it comes out of the wash quite quickly again. Why is there an impact longer term? because the geopolitical risk does have an impact on real economic variables like inflation and like GDP growth, and that is why the market reacts longer term. So just to sum up what we've been talking about, we are now living in an environment of multipolarity, where emerging markets are gaining prominence once again. We're seeing that the US economy could very well slip from that peak of, contributing 35% of global GDP, likely to go down to 17% of GDP by the end of 2050, and that starts to chip away at dollar dominance. And I say chip away because it's going to be gradual. We've seen that there's no close contender to take over from the dollar just yet. In a world of multipolarity, the poorer nations represented now by the global south believe that the multilateral institutions are not doing enough and not doing it effectively to solve for global cooperation issues such as climate change, poverty, and inequality. And I think this is going to be a real threat that we need to deal with in the next while. A lot of protectionism and nationalization is coming about, and we're starting to see these big regional trade blocs forming. What this means for smaller emerging market economies is that you need to be able to be as open as possible to trade with as many countries in an environment like this. This also starts to suggest that you're no longer going to get your goods from the lowest cost producer. You're going to try and make sure that you've got your production lines as close as home as possible, and that means an initially inflationary impact. There are all of these geopolitical flashpoints playing out in the background, and we would expect to live in a world of higher market volatility. While we expect that these main global wars will remain contained in those regional areas, it will ebb and flow, and we will see from time to time when there's a key military event that market volatility does once again spike. In terms of bringing it back to my own home in SA, we think that we do have a chance of the local reforms starting to boost economic prospects as long as the government of national unity can cooperate together in the next while. And how do we navigate these risks? Geopolitical risk factors do affect the market. It's a short hit. It does come out of the wash quite quickly, but it affects it in the longer term through the indirect impacts on inflation and GDP. And in particular, your emerging markets tend to be disproportionately hit. So I'll leave it there and hand over to Richard, who will have a couple of points to share, and then we'll do questions.
Thanks, Sanisha. Fantastic. The title of this section is UM. Does that stand for what on earth do we do with all that information we've just learned? It does not stand for It stands U and M for uncertain and material events. We haven't been wasting our time. We've been talking about uncertain and material events, things that have a bearing on our portfolios. What we should all do in our day jobs, however, is to avoid talking about these things that are material but not uncertain, like whether the sun will come up tomorrow. Talking about that is a bit of a waste of time. Talking about things that equally are uncertain but not material, like who the next Prime Minister of Tuvalu is going to be. With apologies to anyone from Tuvalu, I simply Googled what was the smallest country in the world by GDP. So that's the reason I picked on Tuvalu. Either of those two things, the last two slides, that would be a waste of time. Instead, what we've done for the last 30 minutes is not a waste of time, as I say here. When we've defined what those uncertain and material events are, these key things like elections, like geopolitical unrest, like what's happening with the dollar, once you've done that, there's then two transmission mechanisms to our portfolios. One of those is, well, what does it do to fundamentals? Things like our growth forecast, let's say, which we've done here. This is our base case expectation out to 2029. It's not very exciting, you could say, but this is investment management, not rock and roll. So I make no apologies for that. The second transmission mechanism, you might have guessed it, is through market sentiment. Mr. Market, as often referred to, has a borderline personality disorder, continually swinging from being very excited and greedy to being overly fearful and manically depressive. So sentiment obviously is very important. Those are the two transmission mechanisms. What I'm going to do is give you a quick guide to what I think we should do in terms of dealing with these two things. Number one, as I hope it's going to say here, dealing with these events is get an SAA, a strategic asset allocation. You'll hear us talk a lot about that. I think it's very important. It is important because of this. During the fall and early winter of 1901, the Wright brothers, who I love, tested between 100 and 200 wing designs in their wind tunnel. What were they doing? They were looking at the effects. They were learning from the outcomes. They were just enhancing the process through this iterative process. That is exactly what we do when we build an SAA. We look at history. History has built in all of these examples of elections, of geopolitical turmoil, and want to harness all of that information in creating your SAA. And we don't do 100 to 200 tests. Instead, all of these little grey dots is a new portfolio we're looking at. So we do the order of 2 million tests in devising the SAA. An SAA, great way to anchor your investment, but ultimately there's a lot we simply don't know, no matter how much we talk about Trump versus Harris. Get an SAA, and then when thinking about what looks attractive today, what I might want to do tactically, constrain yourself around that SAA. And that to us means an ex-ante tracking error of about 5%. It's the kind of thing you want to be doing around an SAA. That's number one. Number two here, imagine you're wrong, because we are going to be wrong at times. So back to that previous chart, we don't simply have a base case expectation. Of course, you would expect us to have other scenarios around that, because there's a lot of moving parts. We're never going to get it perfectly right. So that is number two. Number three is track the current mood in the markets. Remember that sentiment factor. How do we do that? We have a proprietary index here, the blue light, that is picking up exactly that sentiment, otherwise known as risk aversion. When this is very high, the market is very fearful. When this is very low, be cautious, because other investors are getting greedy. So that is how we do it. And I said I only need 2 minutes. I'm not aware how long that took. But we're already on the conclusion. And the conclusion is identify factors that are uncertain and material. That's not Taralu. Get an SAA. Constrain yourself around that SAA. Number two, imagine you're wrong, by which I mean consider a range of outcomes, of course. And number three, track the current mood in markets. That is my simple guide to what you do with all that very powerful information that Sanisha shared. And with that, we will amply time for questions. Glenn's looking at me. He really wants us to spend longer out there. But no, in all seriousness, are there any pressing questions, mainly for Sanisha, I imagine? He shared a lot of good stuff.